Hello and welcome to Newsmax's Aftershock Survival Summit. My name is John Burke, and I want to thank you for taking part in this very important discussion. As you know, in 2006, while nobody was looking, neither the Federal Reserve nor the Treasury, not Congress or even the White House, the American economy began a catastrophic descent as the early stages of the real estate crisis started taking shape. 2 years later, in 2008, the true scope of the devastation became crystal clear as the stock market collapsed, the credit markets dried up, banks melted down, and unemployment began to soar. America was thrust into a recession and a period of national misery not seen since the Great Depression. Every citizen in this country felt the stress, the fear, and the uncertainty that came with not knowing how long the malaise would last and how deep the damage would be. Well, we all know this story by now, but why were the people in Washington, whose sole responsibility was to prevent this kind of a meltdown, incapable of protecting us from this crisis? Why did the leaders of America allow our country to sink into this financial abyss? Where were their voices of reason? And what does the future hold for our great nation? And how can you and your fellow Americans on Main Street stay safe from what lies ahead? We'll be addressing these issues today. And you are going to meet a true voice of reason that this country needs right now. You see, back in 2006, while the stock market was surging and real estate prices were soaring, an unheralded team of economists was working tirelessly to spread the word about the impending dangers that threatened our great nation. They released a book called America's Bubble Economy that accomplished what no one else seemed able to. They predicted with startling accuracy what would happen when America's easy money party ended. Their analysis was not the 20/20 hindsight that's so commonplace today. They were well ahead of the curve and swimming against a tide of financial optimism. These maverick economists sounded the alarm about a chain reaction of crashes that were to come in real estate, the stock market, private debt, and consumer spending. They laid out a clear and straightforward message. The end game was near. If the powers that be had paid heed to these economists, the lives of all Americans would have been better. But their warnings were not welcomed by the mainstream media or by those on Capitol Hill, and the devastation is still being felt to this day. Sensing that the worst was still to come, this team of economists returned in 2009 to pen the follow-up book, Aftershock. This time, Americans were willing to listen to the unfortunate truth about our nation's financial health, and Aftershock quickly became a bestseller. This incredible book predicted that two more massive bubbles, the dollar and U.S. government debt, could burst by 2013. And since the release of Aftershock, we have indeed seen the dollar continue its dangerous downward spiral. And as our federal debt keeps surging to unsustainable levels, it's clear that these three economists were right again. You need the real story and what steps to take to stay safe before a second and much more destructive economic meltdown possibly strikes the United States. And that's why we are joined today by one of the three economists who has been helping Americans prepare for the coming crisis. Bob Wiedemeyer, thank you for being here.
My pleasure, John.
Bob, my goal for this interview is to work with you to build an effective action plan for our viewers regarding their homes, investments, retirement savings, debt management, life insurance, and even jobs. But I want to start by saying that you're also not going to mince words or paint a rosy picture for our future. So, Bob, would you say it's safe to say that our viewers need to be prepared for your message that any signs of a recovery may be nothing more than false hope or simply an illusion?
That's right, John.
All right, well, with that, let's get started. Basically, your message in Aftershock was that the recession was bad, but that the worst was still ahead, and Washington is still ignoring the problem. Is that correct?
Well, yes and no. I do believe we have some very tough times ahead for our country. And most in Washington are refusing to address the true scope of the situation. And millions of Americans will face some difficult hills to climb to avoid getting caught up in this economic disaster I see unfolding. There is no getting around that. We are past the point of no return. And people are starting to realize this. CNN released a poll just a little while ago that stated 48% of Americans see our country headed into a second Great Depression in a year or two. I slightly disagree with that timeline, but not that diagnosis. Fortunately, right now, we are still in a critical period. A few simple decisions can be the difference between personal economic obliteration and financial prosperity. This is a situation to be taken very seriously. I can't be any clearer than that.
Okay, before we talk about what lies ahead, let me quickly ask you about the past. How did you predict this multi-bubble collapse while nobody else seemed able or willing to recognize the dangers?
Well, most economists looked at these situations as independent occurrences. They didn't take a broader view to see the chain reaction that could unfold. Since most people aren't trained economists, I usually try to simplify this explanation. So imagine a balloon. You start with a dramatic and artificial increase in home values and the stock market. This basically put all the air into the balloon.
Why do you say it was artificial?
Because people weren't making the kind of money needed to justify these increases. From 2001 to 2006, housing prices accelerated much faster than our income. Now, we all know that housing price growth was due to the mortgage madness, where people could easily obtain loans with no documentation. Liar loans, they were called. So some lenders blatantly looked the other way, and others repackaged these garbage loans into toxic investments.
And this wasn't happening before 2001?
Not really. From the 1980s to 2001, home prices rose in step with inflation, and then in 2001, they just exploded. But nobody stopped to think about what would occur when home prices weren't rising 10, 20, even 50% a year anymore.
And you saw a similar problem with the stock market, right?
Absolutely. It was very susceptible to a massive correction because just like housing, the rapid rise didn't match the underlying fundamentals economists chose to ignore. It's pretty simple. From 1928 through 1982, you had about a 300% rise in the Dow. That's a 54-year period. Yet from about 1982 through 2005, it rose another 1,400%.
But that doesn't sound like a bad thing, though, right, Bob?
Well, that would be fine if our economy grew 1,400% too, but it didn't. Personal income only grew about 10% over this time period, and company earnings about 300%. So the foundation beneath these market gains was very fragile, and the balloon became massively inflated.
So now you've basically got this economy that's completely full of hot air, right?
Exactly. Now the real estate market collapse applied enormous pressure on an already overly inflated stock market. And as foreclosures began to grow in numbers and the banks became weaker, it became harder to get credit, which was a shock to the system because Americans had become very spoiled by this easy money. In fact, between 2001 and 2005, an estimated $2.4 trillion in wealth was created from the refinancing of mortgages and home equity loans. This money was only available because of artificially escalating housing prices. But when this easy money spigot was shut off, a private debt crisis was created. Look at the chart on your screen now to see how fast Americans grew their debt compared to their income. So real estate and Wall Street collapse dried up the easy money, and this led to a massive correction in consumer spending. This is a big deal. Many people don't understand that about 70% of the U.S. economy is built on consumer spending. These four bubbles bursting created one massive American explosion.
There you go. And we all know what happened next. $16.4 trillion in household wealth disappeared. And these losses were felt in our investment portfolios, retirement savings, real estate holdings, and salaries. And you know, it's still just stunning to me that you were in such a minority of voices that saw this travesty unfolding. Hardly anyone was waving the red flag besides you and your team.
Well, most economists didn't see this coming because they couldn't see the forest for the trees.
But you didn't stop there. In 2009, you released the best-selling book Aftershock, which warned Americans of dollar and government debt bubbles that were set to expand from 2009 to 2012 and burst around 2013. Well, in the last year alone, the dollar has dropped, and since Obama has been in office, we've piled on another $3.7 trillion onto our already dangerous federal debt tab. And serious minds like billionaire bond investor Bill Gross believe that the total tab could be $75 trillion or more when you account for Medicare and Social Security. He's even gone as far as to say that the United States will default on its debt while picking the pocket of every citizen through inflation, dollar devaluation, and interest rate games. Now, Bob, our viewers would be in a better place right now if you were wrong on these predictions, but unfortunately, you've been right all along.
Yeah, everybody wishes we were wrong. Count me in that group. But ignoring a problem this large is not the way to stay safe from it.
Now, before we dive into what lies ahead, our viewers could use some good news here. Bob, you and your team have completely updated Aftershock with new analysis, predictions, and powerful guidance. And you are releasing this bold second edition with an even more blunt assessment of what's to come in the years ahead. And here's something that will get our viewers very excited. You're going to give everyone who's watching this interview a free copy of your new book. Even better, you're including the final chapter that was deemed too controversial to be included in the version that will be sold on the newsstands and Amazon.com. So this is a new edition of Aftershock, right? And should the hundreds of thousands of people who read the original get a copy of this latest version as well?
This is absolutely a new edition. And if you found the first Aftershock helpful and informative, this version will be even more valuable to you and your family.
So, just to be clear, only people watching this interview can get this book for free as well as the hidden chapter, right?
That's correct, John.
Well, that certainly is good news. So, what's in this hidden chapter anyway?
Well, just like with the original Aftershock, we've included a great deal of analysis, predictions, and guidance for readers throughout this book. And also, just like in the original, we paint a pretty grim picture of what America will be like if our findings come true. And we left this for the very end in a separate chapter. Well, the publisher believed this final chapter would be found by certain readers, at least, to be a bit too aggressive or startling. So the publisher thought that this could be a problem for some who picked it up at a bookstore without realizing what Aftershock was about. Now, it's not some sort of apocalyptic, end-of-the-world kind of chapter. We just talk about what day-to-day life will be like when the next great meltdown occurs. We also reveal an additional hidden bubble that's being completely ignored by everybody. And we put some great investing and personal finance advice in that chapter as well. In fact, my team and I built a step-by-step wealth protection checklist into this chapter. It covers how to approach your investments, personal finance, and debt in the short term before the toughest times arrive. And we also lay out a simple to follow and effective long-term blueprint for safeguarding your finances when the economy really gets bad. So this hidden chapter is one of the most important in the entire book. But at the end of the day, the publisher just didn't want to take the risk. However, I imagine the people watching this interview right now are a bit more prepared for this kind of analysis. So my team and I are happy to personally send this chapter to our viewers. And I've even autographed the first 1,000 copies of the new edition of Aftershock to give out today.
All right, Bob, this is a long interview. I'm not going to let you go anytime soon. So I'm going to ask my producer if we can put the button up on the screen now so folks can make sure they can get a free copy of this new edition of Aftershock immediately, as well as the hidden chapter. So, Donna, can we do that for the viewers? We can. Okay. We've got the green light to go ahead. So underneath this video is a chance to grab a free copy of the new edition of Aftershock while we still have books available. And if you are one of the first 1,000 to act, you will get one of the autographed versions. Clicking on the button, by the way, will not interrupt this interview. It will just open up a new window on your screen so you won't miss a word. Okay, Bob, let's talk about the future. What's in store for our economy?
Well, to put it simply, we now have a situation where the medicine has become the poison. The federal government and politicians on both sides of the aisle have done everything they can to give Americans the appearance of a recovery. They bailed out their friends at the banks and automotive companies, they've kept interest rates at historic lows, and they allowed the Fed to turn on the printing presses and drastically grow the monetary supply by 300%. And all this has done is delay the inevitable. We will all soon see that while printed money has been the medicine of the so-called recovery, that medicine is about to become the poison when the dangerous side effects kick in.
But this doesn't seem to be hurting the stock market. As a matter of fact, since bottoming out in March of 2009, it's up as much as 94%, and many are saying that it could top pre-recession levels in the near future. So couldn't that be a sign of a possible recovery?
That's all an illusion. Look at this chart and you'll see the stock market's initial gains simply shadowed the money printing trail. And it won't be very long before this money from heaven becomes a path to hell, that hell being inflation. You see, that 300% increase in the money supply we've experienced, well, much of it is sitting in excess reserves at the Fed and with the big banks. These funds haven't made it into the markets and the economy yet, but it's a mathematical certainty that once this dam breaks and this money passes through the reserves and hits the markets, inflation will surge.
So why don't they just stop printing money?
Well, because they don't think it's a bad idea. They've seen how it's propped up the stock market and a good portion of the economy, and they believe they're fighting off deflation. They aren't worried about inflation. And some of the more liberal-leaning economists are calling for even more aggressive money printing. For example, Paul Krugman has stated he thinks the Fed might need to print $8 to $10 trillion to save our weak economy. That's preposterous, and to think that Krugman was awarded a Nobel Prize in economics. Frankly, liberal voices like his are winning out over more fiscally conservative ones such as mine.
All right, Bob, so how bad do you see inflation getting?
Well, I dedicate an entire chapter of the new edition of Aftershock to inflation. And it's a very serious issue which needs a very long discussion. But I'll just say that by the end of 2012, we will likely start to see the first signs of aggressive inflation. I'm talking about 10%, using the Fed's calculations, which we all know are drastically underestimated. And from 2013 through 2016, it's going to get much worse.
Are you talking about hyperinflation?
Absolutely not. That's a bit extreme. We definitely will not see hyperinflation. Hyperinflation is 50% a month or thousands of percent a year. We aren't Zimbabwe. And don't listen to any economist who says it'll get that bad for us. But we absolutely could see 100% annual inflation for a 3-year consecutive stretch, which of course would be a complete disaster for those who are not prepared.
100% for 3 consecutive years? That seems unfathomable. I mean, isn't that extreme?
Well, for Americans it is, but what many don't know is that the most damage will be felt between 10, 20, maybe 30% inflation. After you get past 30%, it'll just be bad all over. You eventually become numb to the effects because there isn't much left to take from you at that point.
How can 10 or 20% be a harder hit than 100%?
Well, once you hit 10% inflation, 10-year Treasury bonds lose almost half their value. And by 20%, any value is all but gone. Interest rates will increase dramatically at this point, and that will cause real estate values to collapse. And the stock market will plummet as a consequence of these other problems. So after 10, 20, even 30% inflation, the vast amount of damage has been done.
All right, so you just touched on interest rates. So you're saying that raising them after the big inflation has kicked in is dangerous. But that's what President Reagan and Paul Volcker did during the stagflation of the late 70s and early 80s. So why can't the White House, Fed, and Congress do it right now before inflation gets out of hand?
Well, interest rates will absolutely be going up in the future. The market will see to that. But before I answer your question, let me say that the Fed is looking to every other solution before taking the steps that Reagan and Volcker did. That's why they have been buying our own bonds and calling in favors across the globe. The United States and other countries will make dramatic efforts to save the dollar and unsuccessfully stave off serious inflation, especially the Chinese central bank. They bought over $1.1 trillion of our Treasury debt to prop up the dollar's price so they can boost their exports to us. On top of that, they've got about $2 trillion of U.S. securities when you add in all their other U.S. bond and physical dollar holdings. Japan is sitting on $900 billion in U.S. Treasury debt, and since 1980, the percentage of U.S. debt held by foreign investors has almost doubled. Frankly, the United States has put itself in a position where it owes some very powerful countries like China a lot of favors, which is not good for us. Imagine if we start leaning heavily on the oil-rich countries in the Middle East to prop up our dollars. These countries really aren't pro-America.
Yeah, not so much. That doesn't sound like smart foreign policy.
It's not, and it will end whether the U.S. wants it to or not. Based on my analysis, I predict foreign investors will begin to significantly lose confidence in their U.S. holdings sometime during or shortly after 2013. China is already beginning to worry, but this will get much, much worse when we hit 10% inflation. And by 2016, a mass exodus of foreign investment could very well occur in the United States. And whether we like it or not, we need foreign investment in our stock and bond markets to keep them strong.
All right, so that brings me back to my question. Why not put Reagan and Volcker's plan into play right now and aggressively raise the interest rates?
Well, from a purely economic standpoint, hiking the interest rates as Volcker did would end inflation quickly. But remember, back in the 80s, interest rates on loans for businesses and people were hitting over 20%. You had massive protests. Farmers actually drove tractors through D.C. because they were outraged that they couldn't afford to operate their businesses. So it's a politically brave move, but it's not one without public backlash. But the biggest reason we can't aggressively spike the interest rates is it's economically impossible, given our current government debt situation.
Now, can you go into a little more detail about that?
Absolutely. Right now, we collect about $2 trillion a year in taxes. But nowadays, Washington is spending almost $3.5 trillion. That means that more than 4 out of every $10 the government spends comes from borrowed money. And government debt is mostly short-term in nature. About 36% of it is in loans that mature in under a year. So Washington has to constantly roll this debt into new loans at the new interest rates. So what if rates rose to 10%? Well, we would have a hard time just paying the interest. So they will start with small raises in a futile attempt to curb inflation, but at the same time, they will print more money to help keep from drowning as the interest rates hike the annual deficit.
That sounds like 1 step forward and 2 steps back.
It is. So modest interest rate hikes are coming in the near future. It won't stop the inflation, but still Washington will exhaust all possible options because they know that aggressive interest rates will crush real estate, stocks, and bonds. And it will pop the bubbles they've inflated through reckless economic policies. So instead of acting now, they'll wait until there's no choice and the devastation is unfolding before they make the uncomfortable and unpopular decision to dramatically spike the rates.
Do you think one of these revenue-boosting options will be to raise taxes?
Unfortunately, yes. And it won't matter who's in the White House in 2013. I don't think there is any getting around that. I don't like it, but it's the lay of the land. They'll target the wealthy at first because, well, politically it's the easiest road to take. But that won't get them enough money. They'll need to go after middle-class Americans. They'll target average investors heavily. Seniors who live off investment income will have a harder time getting by. And all of this overtaxation won't solve the debt crisis. And it's not the only problem Americans are going to have to worry about.
All right, let's discuss one of those problems: housing. Recently, the Wall Street Journal announced that national housing prices fell for 57 months straight. So what lies ahead for homeowners?
Well, in the immediate future, we will continue to have a slow fall. Median housing prices dropped 8.2% in the last year. In fact, the beginning of 2011 brought about the worst single quarter in real estate since the recession began. But some people may get their hopes up once our market improves or at least flatlines. But midterm foreclosure expected to jump 20% this year. So I believe people will lose, on average, about another 5 to 8% of their home's value in 2012. Some places will be much worse and some will be better. And long term, we are going to witness a massive collapse, I believe even worse than the first. Right now, research shows that more than 1 out of every 4 homeowners is willing to walk away from their homes. Once the inevitable interest rate hikes set in and the values of people's homes drop even further, that figure will jump even higher.
Because paying off a mortgage won't make as much sense as simply walking away and renting, right?
Exactly. The scope of the damage will be determined by how high interest rates eventually go. Housing expert Robert Shiller believes home price could fall 25% in the next 5 years. I think it could be even worse. Consider this. If mortgage rates hit a reasonable 7.5%, it'd basically mean home price would have to decrease by as much as another 32%. And 7.5% is very reasonable. I mean, my parents' mortgage in 1968 was 6.5%. When I graduated college, it was 15%.
All right, Bob, in a few moments, I'm going to tap into your brilliant mind so our viewers can get your investing, personal finance, real estate, and even job tips. And we'll give everybody watching this interview a free copy of the second edition of your rewritten and updated bestseller, Aftershock. Plus, the hidden chapter your publisher didn't print in the version available on newsstands and online sites like Amazon.com. But before we do, let's hear details about what lies ahead for the stock market and investments in general.
Okay, here's how it'll play out. And just remember, there are always incredible opportunities in the markets, no matter how bad it gets. You just have to know where to look. In the short term, the massive money printing we've seen over the last few years will continue to prop up the stock market. But starting in 2013 and growing worse and worse through 2015 and 2016, the medicine will become the poison on Wall Street. High inflation, rapidly rising interest rates, and the heightened risk of U.S. debt will create a poisonous cocktail like we've never seen. So government investments and those tied closely to them will become pretty dangerous bets. But these higher interest rates will hit the overall stock market just as hard too. Companies will be spending more money on borrowing costs as opposed to business expansion costs. That means lower profit margins, lower dividends, and less hiring, plus more layoffs.
Okay, so put a specific number on the impact this will have on the stock and job markets.
Well, in the first edition of Aftershock, I laid out a situation where we could see as much as a 90% drop in the stock market and 50% unemployment. That is the worst case scenario, and I stand by that assessment. But let me make it clear that regardless of how bad it gets, this will be temporary. We will recover from all of this eventually.
Bob, what will life in America be like if what you predicted in both editions of Aftershock comes true?
Well, I believe many Americans who don't listen to my advice in this new edition of Aftershock will lose most of their money. But these people won't starve in the streets. Compared to most countries, America and Americans are still very rich. Even if our GDP dropped in half, we would still have a $7.5 trillion economy. But many people's savings could be drastically lower. Just about everybody's home will be worth much less in 5 years. Bonds that back up a lot of pensions and life insurance policies will be destroyed. Pensions will become unstable. Some forms of life insurance could be eliminated. The stock market will plummet. And all of this equals more job losses. But people won't be rioting in the streets, although there'll certainly be many angry demonstrations like we recently had in Wisconsin. Remember, we didn't see rioting in the Great Depression. The pain was felt at home. and that's where it will be felt this time as well.
And really, this is all because our government has not learned that, as you've put it, money from heaven is a path to hell. You aren't exactly painting a very positive picture for our audience there, Bob.
Well, look at it this way. If you had pneumonia and all your doctor did was tell you to not fret and take 2 aspirin and you're cured, would you still use that doctor? Of course you wouldn't. This situation's no different. People need an honest diagnosis concerning our economy and the best medicine for keeping their money healthy and safe.
You're right. So let's discuss the ways our viewers can protect their wealth in the troubling times ahead. Now, I realize you go into greater detail on all of these points in the new edition of Aftershock that has just been released. So our viewers can use the free copy they're going to receive to get more information. And they can look to the hidden chapter that won't be seen by those who grab the book from Amazon or any other retail bookstore for greater insight into what has caused this crisis and how bad it's going to get moving forward. You even reveal a hidden bubble in this chapter that nobody's talking about, but could have serious consequences for millions. Most importantly, this chapter includes a step-by-step checklist our viewers can follow to protect their wealth now and in the years ahead. But let's focus on solutions right now. What should our viewers be doing to stay safe?
Well, first and foremost, I advise people to stay away from real estate. Real estate has not hit bottom. Higher inflation, mortgage rates, and unemployment will suffocate the few breaths remaining in the housing market. In my opinion, strictly from a financial standpoint, people should consider selling their homes while they still have a chance and rent instead. But I understand that's not practical for most people, and the emotional attachment to a home goes beyond financial matters. So if you're stuck in an adjustable rate loan, I advise you to immediately refinance into a fixed rate, and I mean now. Don't put this off, do it now.
Okay, should people staying in their homes who have a fixed rate mortgage look to pay it down faster?
Absolutely not. Higher inflation in the future means you will be repaying a cheaper mortgage since the dollar will be worth much less. So stick to the minimum payment for now and use that extra money for shrewd investments, pay down more important debt, and definitely save as much as you can for a rainy day, because we'll see quite a few of them in the years ahead.
What about non-real estate loans?
Well, the most important one is your car loan, especially if you're still working. An average car loan for Americans now is about $12,600, so it's not a small chunk of change. But a repossessed car is no good for you now or when you need to secure financing for another one in the future.
What about credit cards?
Well, many credit cards are simply adjustable rate loans. Even the fixed rate credit cards have loopholes that allow them to hike your rates. So when interest rates rise, so will rates on the many of the cards you are holding. So pay those off as soon as possible. If you take my advice and pay just the minimum on your mortgage now, you can use the newfound extra money to pay your credit cards down faster.
All right, how should our viewers approach insurance?
Well, a good topic for this discussion. Once inflation hits 10%, all life insurance policies will be susceptible to very big losses due to their heavy exposure to long-term bonds, commercial real estate, and stocks. Some insurance companies could even crumble. So given our current situation, in my opinion, it does not make good financial sense to own whole life insurance. If you do, you may be able to take out a lump sum payment now. This will be much more valuable to you to properly invest now than when inflation really kicks in. Check to see your policy details on that though. You can also focus on term life insurance instead, since it's much cheaper.
You know, it seems people are putting off retirement until later and later in life. As a matter of fact, Wells Fargo recently released a survey that says people in their 50s, on average, only have $29,000 saved up for retirement. And with Social Security, Medicare, and the unreported tens of trillions of dollars in future costs pressing down on our economy, the safety nets many have relied on may not be there in the years ahead. So for our viewers who may still be working and do not have enough saved up for a comfortable retirement, if we have a serious spike in unemployment, what careers will be the safest in the years ahead?
Well, this is truly a sad epidemic. Given the pullback in income growth, as well as other economic factors like inflation and a weakened dollar, the retirement age would now have to be raised to 73 for average Americans just to maintain the same standard of living in their golden years as people in the 1940s enjoyed. Since the average life expectancy is currently about 78, millions will have to work until they drop dead instead of enjoying their golden years. Plus, Washington seems incapable of having an adult conversation on the entitlement issue. So I personally see people working later and later into their lives because they have no other choice. However, jobs will be very tight, especially for people over 55. So for those seeking job security during the coming crisis, the necessity sector is the place to be. Now this is composed primarily of healthcare, education, utilities, basic food, basic clothing, and government services. Unfortunately, these aren't the highest paying jobs.
Whether people are still employed or living off their investments, they are worried about the government taxing away more of their money. So what can our viewers do to help protect themselves from higher taxes?
Well, we need to see how this one will play out, and obviously our viewers should really build a specific strategy with their accountants. But I'd quickly recommend looking into estate planning, regardless of your net worth, because for tax reasons, giving gifts to your children and grandchildren now can be very beneficial. And you can get creative here by selling assets to buy gold, to gift to your heirs now as opposed to in your will. This will be much more valuable than cash or real estate when inflation hits hard.
That's a good segue into investing advice. So it seems you are a fan of gold still, even though it's been soaring in value.
Yes, absolutely. I'm not a gold bug by any means, but I know what investments are right for different conditions. Gold will continue to be a favorite safe haven for countries across the globe. Right now, only 10% of the world's gold is purchased by the United States, which puts us right in line with, say, Turkey. India currently buys more than 20% of the world's gold, China 18%, and other countries will increase their stakes in this precious metal as confidence in the U.S. wanes. But gold is just like any other bubble. It will burst eventually.
And when do you see that happening?
Well, I could see gold's bull run lasting at least another decade or more before the bubble bursts, and we'll see truly remarkable prices during that time. We dedicate a good bit of one chapter in the new edition of Aftershock to explaining the smartest ways to invest in gold now and over the long term.
Could you touch on some of those ways?
Sure. As an alternative to carrying physical gold, you can buy it from a gold depository. With a depository, you have legal ownership of the gold, but don't have to take physical possession, although you can anytime you like. You can also buy gold ETFs that are 100% backed by physical gold, which we discuss in more detail in the book. We've seen many billionaires and hedge funds begin to pour more and more of their wealth into gold over the last few years. I also like gold mining stocks. In fact, gold mining stocks have long periods where they actually outperform physical gold. But not all gold mining stocks are created equal, so my team and I point out how to identify the best opportunities in the new edition of Aftershock.
What about other investments?
Well, other precious metals like silver and even platinum are good choices over the long run. Until serious inflation hits, short-term bonds are okay. After inflation really sets in, you'll need to keep cash in short-term investments such as money markets, tips, and T-bills. Their low returns don't exactly make them very attractive, but they will protect you against inflation much better than longer-term debt. I highly advise our viewers to stay away from long-term bonds. And let me stress that again, avoid long-term bonds, okay?
What about some unconventional investments that our viewers may not have considered before?
Well, foreign currencies are a great play right now for investors. I like the Canadian dollar, Swiss franc, and the Nordic currencies, such as Norwegian kroner. Trading currencies directly can be pretty risky, so that isn't for everybody. But you can buy ETFs in the major foreign currencies like the euro, yen, Canadian dollar, Swiss franc, Norwegian kroner, or other Nordic currencies. And you'll want to hold them as longer-term investments that will appreciate as the dollar continues to fall. You can actually buy an ETF called the UDN, that's UDN, that trades all of the currencies in the US dollar index against our currency. So the weaker the dollar, the higher the UDN goes up, and the more money you make.
And what about advice for our more seasoned investors?
Well, a very large portion of the new edition of Aftershock addresses tips for investors of all shapes and sizes. For example, the more experienced investors may find a great deal of benefit reading up on what kinds of options we think are suitable for profiting during the days ahead, or how to properly take advantage of U.S. agricultural commodities. Because when the dollar weakens, lots of countries will be buying our commodities with their stronger currencies. Aftershock is perfectly suited for everybody because along with all of these great investing tips, we also offer advice for real estate, personal finance, money management, safe retirement, and even our viewers' careers. We don't leave any stones unturned.
Yeah, I couldn't agree with you more, Bob. The new edition of Aftershock is incredibly comprehensive and eye-opening. We've just scratched the very surface in this interview. These are all very serious topics that need more time than we have today to truly go through. And Bob, you're giving our viewers an incredible opportunity to build an unbreakable wall around their wealth that will protect them when the economy hits the very rough times you forecast in the new edition of Aftershock. And your message that the time to act is right now is very clear. You know, Bob, I wish our leaders at the Fed, the Treasury, Capitol Hill, and the White House had listened to your repeated warnings over the years, but they didn't. Fortunately, over 250,000 Americans grabbed a copy of the original Aftershock, and they flooded Newsmax with letters showing their appreciation. As a matter of fact, I'd like to show a few on the screen right now.
I owe Aftershock a debt of gratitude for confirming my growing concerns about the direction our economy was going. It gave me the courage to make a move which, had I not made, would have left me behind the 8 ball.
Over the past year, we have managed to earn enough to cover our living expense withdrawals times 2. So we have more money than we had a year ago, thanks in very large part to Aftershock. I gave a copy to each of our kids and one to a neighbor.
I found Aftershock to be my original guiding light. It placed me in the zone to formalizing a plan. Therefore, I say, right on with edition number 2. This reader will be the first to purchase.
Aftershock altered my entire investment outlook. Because of Aftershock, I purchased gold at $900 and silver at $14.
My wife and I have read the book more than once and taken steps to protect our net worth and profit from the downfall of our economy. We've already profited. In fact, we're just starting to feel sure that we can come through the next several years with excellent financial results.
And the reviews from the press and prominent figures were just as positive. Obviously, Aftershock was viewed by many as a vital resource for Americans. But what was your motivation behind creating this entirely new edition?
Well, John, my team and I still had a lot more to say. And now that a couple of years have passed, we had an opportunity to analyze the economy again, update our predictions, and offer even more advice for staying safe. We created the second edition of Aftershock so people who enjoyed the original book would immediately recognize it and look to it for guidance. And people who had not yet read the first edition still could protect themselves, because there's still time left to do so. Not much, though.
Bob, as you know, Newsmax believed so much in the first book that we gave away thousands of copies of it for free. This came as a great cost to the company, but your warnings and guidance needed to be heard. And your second edition of Aftershock picks up right where you left off. It really is remarkable. The message is even more important now. The solutions are even more critical for survival in the dangerous economic times that lie ahead. So Newsmax is going to do it again. We are going to give out a free copy of your brand new second edition of Aftershock to everybody watching this broadcast right now. This book is going to be sold for $28 on newsstands and online retailers like Amazon. The first 1,000 copies will be personally autographed by you as well. But the version Newsmax is giving away will be a little different than the one that's going to hit the stores, isn't it?
Well, yes. You see, the publisher wasn't exactly comfortable with our outlook for the future, so they requested we omit a very important chapter that offered a grim assessment of what we saw occurring when the dollar and debt bubble burst. And this chapter also describes a third bubble we saw on the horizon that absolutely nobody is talking about, but they should be. Plus, we added some very specific tips for safeguarding your wealth in this section and a step-by-step checklist for preparing your investments, retirement savings, debt, job, and much more.
Given your track record, Newsmax wants this unpublished chapter read. So every viewer will receive it when they accept their free copy of the new and rewritten edition of Aftershock. In this edition, you discuss the need for Americans to build a short-term and long-term protection strategy to prepare for the crisis you see starting in 2013, right?
That's correct. We lay out specific investment, personal finance, and everyday changes needed for both of these strategies. The second edition of Aftershock is very comprehensive because Americans face a complex and serious situation in the years ahead.
Well, Bob, Newsmax wants to do its part to help ensure our viewers have the guidance they need to put the strategies you describe in Aftershock to work. So, in addition to sending you a free copy of the new and rewritten second edition of Aftershock, as well as the unpublished chapter that was deemed too controversial to print and distribute to bookstores and online retailers like Amazon, Newsmax is also going to send you a free copy of the critical briefing, The High Income Report. Because as the economy begins an even more dangerous freefall, you'll need more income immediately to safeguard you and your family's wealth, as well as sound guidance on managing your money. Disclosed in this report are 4 ultra-safe income investments, 3 aggressive income plays, 3 MLP investments that could deliver huge returns from energy, 3 foreign currency funds that will soar as the dollar continues to weaken, secrets for staying safe from the stealth tax, the 3-step checklist for picking dividend stocks, and a realistic retirement plan for turning every $50,000 into $1 million. The High Income Report has a $99 value, but it's yours for free. And for your long-term protection strategy, we are including 100% free trial subscriptions to Newsmax's esteemed investment publications, the Financial Intelligence Report, the Gold Stock Advisor, and the Franklin Prosperity Report. The Financial Intelligence Report is Newsmax's flagship investment publication. It combines the vast knowledge and expertise of some of the world's most trusted voices in politics, the economy, and investing. Here, you will receive powerful stories that aren't being reported by the mainstream media on the issues that affect your wealth. Plus, you'll receive investment recommendations so reliable that since 2003, 85% of all picks have been winners. And the returns have more than tripled those of the S&P 500. With Newsmax's Gold Stock Advisor, you'll join David Skarica, who is one of famed investor Sir John Templeton's most successful protégés, on an exciting journey to hunt down the biggest profit opportunities in little-known gold companies. And Newsmax's Franklin Prosperity Report will give you the wealth protection tips you need so that you can follow Ben Franklin's immortal guidance of a penny saved is a penny earned. Because you have decided to take the necessary measures to protect yourself in these troubling times, Newsmax wants to do our part to help you. Bob Wiedemer, thank you so much for taking the time to sit down and talk with me today.
It was my pleasure, John.
You gave our viewers a great deal of guidance and insight, and you're going to give them a great deal more when they claim a free copy of the rewritten second edition of Aftershock. This now concludes Newsmax's Aftershock Survival Summit. You can claim your free copy of the new edition of Aftershock by clicking the button below this video now. I want to thank you for joining us today. I'm John Burke. Stay safe.